results. Revenue at 3.17 billion euros, up 4.2% year over year.
Reporting third quarter sales up 4.8%. Franklin Golf Romeo.
The Fed policy will be driven by the pace of the data. Same policy will remain accommodative.
Futures off the session's low, still down about 1% on the day for a little more than 4 pennies.
The goals for this session are to answer a couple of questions. Have HFTs eliminated intraday trading? Is day trading dead? We're going to discuss how SMB has adapted to HFTs, and we're going to highlight the strategies that work best for today. So proper perspective. There's this idea that computers, algorithmic trading computers, are ruling and eliminating all intraday traders, all short-term traders, all swing traders. And we're going to talk about that with the proper perspective during this presentation. So, many years ago, when we were beginning to grow SMB, and after a period where we had done really well as a firm, I got this email that was sent to me on a Friday night as I was getting ready to go home and enjoy the weekend. And essentially it said, how come you all are using computers to trade instead? How come you all are using people to trade instead of computers? Aren't you kind of stuck in the Stone Age here? And basically the guy was calling us out to be dinosaurs. And there was a period of time when, or maybe around 2009 and 2010, where algorithmic trading, HFTs, were getting a lot of really bad press. And there was a complete overreaction about their influence in the entire market, to the point where there was a really funny quote from Kid Diamond, who's an awesome blogger, about HFTs being blamed for everything. Quote was, he wrote this in a blog, was HFT responsible for Obama winning the Nobel Peace Prize? Can the dominance of the Yankees be explained by HFT? No. So look, there's lots of misinformation about HFTs, algorithmic programs, intraday trading, swing trading, and we're going to attack some of those myths and that misinformation in this presentation and leave you with a true picture of really what's going on and how computers have impacted and affected short-term trading. So really we could just call this presentation Adapt. We don't actually have to throw in HFT part. We could just say how to adapt as a trader. The importance of adapting in your trading career. I have changed my trading style numerous times over the course of my career since I began. I first started trading in the late 90s, and I was a relative strength trader. And then I became a momentum trader when the internet bubble just started. Well, it wasn't a bubble then. It was the internet explosion. I was a momentum trader then. And then there were periods of time where I was a fade trader. And then there were periods of time where I was a momentum trader again, but not like during the internet times. I was a momentum trader to the downside during subprime and during the bank crisis. And then today, I've kind of gone back to being a trend trader. I look for stocks that are trending, strong, weak. I look for stocks that have independent order flow to the marketplace, and I try and ride the trend for those particular trades. But along a period, along the time frame, along the timeline of my trading career, I've had to pivot. I've had to adapt. This firm, our firm that we run, has had to pivot and adapt. And it's not going to change. There's going to be there's going to be times where we're going to have to pivot and adapt and change again. And I think one of the things that gets lost in all of this about HFTs and computer programs is that tweaking our systems is no different than me when I had to tweak my system to trade the internet stocks, the high-flying internet stocks. I couldn't just trade the high-flying internet stocks the way that I had traded a couple of years before that as a relative strength trader. I had to be much more aggressive. I had to take much more of a chance with my particular positions. You know, I had to pay the offer for a point sometimes. And sometimes that didn't work. I mean, I remember trading a stock KTEL. It had no earnings. It had announced that they were thinking about going into the online music space, and they weren't in this space at all. And this was like, but the stock was moving, and I had to pay a point spread to trade this stock if I wanted to be in it. And it was a really good opportunity because the stock would go up, 10 points per day on certain days. Of course, it would pull back a lot too. But I had to be much more aggressive than when I first started trading. And then that period ended. And I couldn't just pay the offer in high-flying stocks anymore if I wanted to make money. There was a period where that just stopped working. And so we fade traded for a while. And then there was a period of time where fade trading really wasn't the best way to attack the markets because we started to trade down very, very much so for a couple of years. And then now we've been in an uptrending market for a long time, and people who are fading and shorting, like we did in 2006 and 2007 and 2008, that's not working. So you're always going to have to adapt and tweak, no matter what your trading style, no matter where you trade, what part of the world you trade in, what product you trade in. It's just always a process of adapting. There's never going to be a destination you get to where you've learned everything and you never have to do anything differently. Even algorithmic programs that crush it, they're tweaked every single day. So you are, as a trader, you're going to have to do that as well. The secret truth about trading is you're going to have to adapt. Even after you learn how to become consistently profitable at certain patterns, they're going to change a little bit. You're going to have to tweak them. Okay, I was a relative strength trader, then I was a momentum trader, then I was a bounce trader, then I taught myself how to fade, then I shifted to uptrending stocks, and I was whacking the bids to the downside. So I've had to evolve. And certainly many have been eliminated by the markets because of the HFTs. I should take a step back. Many have been eliminated by the markets since I started trading. I don't think, and I would strike what I just said. I don't think that they've been eliminated because of HFTs. And the reason for that is I just think a lot of these traders just didn't adapt. I think that they didn't take the time, they weren't willing to change their style that had worked for them for maybe 2-3 years, where they had success. And so SMB sits right now in a JV in New York City with another firm, and we were looking for experienced traders to add to our JV, to sit around SMB, our legacy traders. And I spent a great deal of time, and have spent a great deal of time, interviewing people who are quote-unquote experienced traders, people who have had really big years in the past. I mean, people have made over $800,000 a year, people have made over 7 figures a year, people have made over $500,000 a year, just tremendous success in the past. But maybe over the last couple of years, they weren't making as much money. Guys who were making 800, maybe they were making $150. And I interviewed, and our firm interviewed tons and tons of these guys. And something became very clear to us after talking to the guys who had done really well in the past and weren't particularly doing that well right now. And that was, they didn't really have a methodology. There was too much of a reliance on their own intuition. They hadn't really sat down and understood why they made money when they made money. and just interviewing hundreds and hundreds and hundreds of people and asking them, you made $800,000, you made $1 million years ago. Like, why do you think you're not making that much money right now? And there was no recognition. There was no recognition that they weren't taking the steps to actually get better. They weren't taking the steps to trade this new market. They were just hoping that things would be like they were. And that's just not the way it is with the markets. So I wrote this a while ago, which is, there's always a solution to your market underperformance. And it really isn't matter. If you get to the point where you become a consistently profitable trader, there's going to be a challenge. There's going to be a time where you're going to have to adapt. And there's going to be a time period where you're underperforming, even after you've done well. And you're going to have to dig deep into your trading and find the solution. So I empathize with those who have struggled because of HFTs, and I can tell you that I have heard many traders on the desk use this term, effing chiseler. And really that's what HFTs are. They're chiselers. You go to offer a stock at a particular price and they cut you. You go to bid for a stock at a particular price and they cut you. They do this all day long. And they are so fast that they can buy and sell a stock faster than you can blink your eye. They can buy and sell a stock faster than you can blink your eyes. That's how fast they are. But in their essence, they're just a bunch of chiselers. And we used to rail against chiselers on our desk. And there's a really funny story I wrote about in One Good Trade, where when I first started trading, we traded in eighths and quarters and sixteenths, and then we went to 30 seconds. And then there was a rule that you actually couldn't cut somebody by 5/64ths. We actually got to the point where you weren't allowed to chisel anymore. And we had a firm rule on this. And sure enough, this guy in our firm ended up chiseling in 64ths for a particular sale, and the head trader found out about this. And the head trader, we used to also have a system where you could tell who was buying and selling a particular stock. So the head trader knew who the chiseler was, and went over to that trader and in a very succinct recap, asked that trader to get off the desk and go for a very long walk. And that trader was reprimanded and instructed never to do that again. And so this has been going on since I started trading. One of the things I think you got to take away from all of this, you can sit there and you get yourself all worked up about HFTs are chiseling you and they're cut in front of your orders and you can't get stock. The reality is that I've never made a dime complaining about anything in the market. And I would suggest to you, you're never going to make a dime complaining about the market structure. We don't set market policy, okay? Go talk to Senator Schumer or become Senator Schumer if you want to actually do that. We trade. We're traders. And you can write a letter to the SEC and your Congress people, and you probably should do that. But then you should get back to work and you should deal with the market that is. You're not going to make any money complaining. So, look, there have been changes, there have been new challenges because of computerized programs. But again, once we understand these challenges, we can then start to adapt and tweak and change our trading so that we can trade around the HFTs. It's certainly true that you get stopped out more because of HFTs. And essentially, HFTs are trading more. They are bringing in this sort of false volume to the marketplace, and that causes stocks to touch more prices. And because stocks touch more prices, that's going to cause all of us, no matter what time period we trade, swing, longer term, short term. Because stocks touch more prices, that's going to cause you to get stopped out more. And here's an example in a particular stock I was trading where I got stopped out and the stock went down 3 more points. I actually wrote an article about this for SFL magazine. This is a chart from SFL magazine. And I wrote this article years before anyone was even complaining about HFTs. And I talked about the things that you needed to do to adapt because of computerized algorithmic programs. And you can see here I was short at 44. There's long-term support, but it gets below there, it makes a new low. So you're thinking, wow, this is a really good short opportunity because it's now below long-term support. I got short in front of 44, it went up, I got stopped out. But, and this is one of the things that you're gonna have to learn about if you wanna trade in this new market structure, there's gonna be times where you ought to get back in. And if you have good tape reading skills, we'll talk about this, you can get back in and you can stay in these moves. But if you just wanted to sit there, carp and complain, you'd get stopped out and you'd miss that opportunity to get back in. Reading the tape skills are necessary. And so, a good example of that is trading Capital One around this 42.30 level. And you can see from trading this example that 1, 2, 3, 4 times it does violate this 42.30 level. And just like in Mohawk, there was a violation of the level, there was also opportunity to get back in. And if you have really good tape reading skills, you'll learn when to get back in to positions you got stopped out of. There's going to be some setups that don't work or don't work as well. So one of the programs that we've identified on the desk, we call it Buy the New Low program. And so what happens is that anytime a stock makes a new intraday low, automatically there are programs that go on that buy the new low and cause the stock to artificially go up, trying to catch short-term traders who are getting shorter or short into covering. And certainly there are strategies that we do not emphasize on our desk anymore. So when we first started SMB, we talked a lot about momentum trading, scalping, micro scalping, and teaching guys how to trade that way. And those strategies don't work as well in this market. You can still momentum trade, and that's a very effective way to be a consistently profitable trader, but you should do less of it, and you have to pick your spots much more selectively. You still can scalp, but you gotta be more selective about it. And today, we teach our younger traders to be more swing traders. We say trades to hold. Get into trades to hold. Hold them until there's a reason to sell. All right, and so what we're doing is, and I wrote about this in the playbook, is we're sidestepping the HFTs. And I remember actually a summer training session that we had about a year ago, and one of the newer traders said, "Oh, what about HFTs? We're really concerned about getting shaken out and having to trade against them." And one of our traders, K-May, spoke up and said, "Yeah, we don't really trade against the algorithmic programs. We don't trade against them. Like, we're not trying to micro scalp like they are. They're trying to make a half a penny or a penny. We're not doing that. What we're doing is we're looking for stocks with independent order flow that are stronger than the market, that are weaker than the market on an intraday basis or a short-term basis. And we're not involved in we're not trying to make a half a penny. We're not doing what they're doing. They're not affecting us as much as the financial media would expect that they would. They pose certain challenges, and there are certain setups that don't work as much. But what we're doing is sidestepping the algorithmic programs. We're playing a different game. We don't have to play their game. We wouldn't be as good at their game. They're too fast. We're not playing their game. We're playing our game. Certainly institutional buying has improved since the advent of HFTs. So there used to be institutional buying that you could pick up. They'd leave a footprint. It was very sloppy paying on the offer of a stock. They would just pay the offer, pay the offer, pay the offer, pay the offer, and they'd leave this footprint foreshadowing that they had a very big buy order. And you could see the footprint, and you could figure out a place to get long that particular stock, get in, and catch a nice move. Now with Now with programs, lots of institutions just put in their big orders to buy or sell with what we say are passive algorithmic trading programs. So they go to the bid and they stay on the bid, they try and get hit on the bid. If you hit them too much on the bid, they drop out and they go lower and they step back up again. All right, if they have to pay the offer, they'll pay a little bit, then they bid a little bit higher, they pay the offer, they pay. And so they're very slowly and very methodically buying stocks on the bid and trying not to leave this footprint. They're not spraying the offer as much as they used to. They're tapping into the technology to be quieter. So how do we adapt to that? You know, there still are ways to see institutional buying come in, but we have to be more careful about buying pullbacks at good prices, and we have to hold these positions for longer if we actually want to be successful in this type of marketplace. There's more false buy signals that have been created. This can be very frustrating. Remember, because of algorithmic programs, more prices are going to be touched, so there's going to be more false buy signals. It's certainly harder to get stock at times. This is an example of somebody on the outside trying to look in. You bid for a stock, they cut you. You offer for a stock, they cut you. A big part of the game today actually is learning to become pretty good at having access to dark pools and understanding how to hide your orders so that the algorithms don't pick up your bids and your offers so they can't cut you. I spend entirely too much time becoming expert in dark pools. Slippage is going to increase. It used to be we could get out for a penny, 2 pennies, and now we're seeing slippage. At times it can be much, much more substantial. There's going to be more reversals. We call them V patterns. You got to be mentally agile for this. A good example is Visa. That's funny. A V pattern in Visa, a reversal pattern in Visa. But you'll see lots of times stocks start to form a downtrend. So there's consolidation at 77 around 1 o'clock, and it breaks to the downside, and you're thinking, oh, now it's going to trend to the downside for the day. That chart pattern right there often indicates a intraday trend opportunity. And we go down a point, and then boom, we reverse. We get the V pattern. There's more of those because HFTs are coming in and they're putting on strategies. They're putting on lots more strategies that make markets move in certain directions and move in weird directions more often than not. Trading against the algos, okay? We don't trade against the algos, all right? We don't trade against the algos. We sidestep the algos. And I say this in a lot of my lectures, trading is a privilege, it's not a right. You're always going to have to tweak what you're doing. All we can ask for in the marketplace is opportunity. And as long as you can buy a stock and you can sell a stock, that's more opportunity than there used to be in the early 90s. Electronic trading is very new. There were times where you, and I'm sure a lot of you remember this actually, you had to call up on your phone to a broker who would place your order. And the only people who actually had access to the inside markets were the people at big institutional banks. You had to work at Goldman Sachs or Morgan Stanley to actually be able to trade on the inside market. Now you can do that. And as long as you could buy a stock and sell a stock, there's opportunity. All right, if anyone has any questions, happy to answer them. And please check out our blog for wonderful commentary on our trading and stories we're sharing with the trading community. Thank you.